So basically, as we have already covered few things, I will just go through it once again. So here we will study DCF techniques, that is discounted cash flow techniques, how to discount cash flow and take some decision regarding the investment opportunity, whether we have to invest or not, or is investment giving us proper yield or not. These things we will be covering here. How to do it? By first evaluating the time value of money. That is, money received today is much better than the money received after 1 year or after some time. Because of first is inflation, because inflation is increasing. So the amount or the things that you can purchase right now with rupee 100, suppose, is more than what you could purchase after 1 year. Second is the cost or expected return. Suppose 100 rupees you have to invest somewhere. So right now, either you have to borrow it, that will cause you interest immediately, or you can invest it somewhere where you can earn something which will be lost if you will invest, or if you'll put this money in some opportunity instead of investing somewhere else. And third is obviously the risk factor. Money received today is obviously less risky than money received after 10 years, because we don't know whether we'll be receiving 100 or not, because we can't foresee future. So obviously the money received in future is riskier than the money received today. Then by having a present value, we can calculate NPV, that is net present value. What is the present value of the future cash flows against the present value of the future inflows, and the net amount, whether positive, that is surplus, negative, that is deficit, that will be left with the person who is investing, or the impact on the shareholders' wealth. Last is IRR, that is internal rate of return. It is the return on investment or return on the investment opportunity that we are entering into, which will be yielded over the period of the investment. Now, time value of money may be compounding, means we have to calculate the future because it is interest on interest. It is a compounding factor that is associated with the time value of money. What is compounding? The question will come. It means suppose 100 is invested right now, 10% is the return that you are getting on it. So after 1 year, it will become 100 plus 10. Total is 110. Next year, 10% return. You will not get on 100, but you will get on 110. That is compounding impact. Means you will be earning interest on interest, or interest on the return that you've earned over the period of a year. Okay. Next is cost of capital. That is none other than your interest rate or your cost that you will be incurring to get the money to invest in this particular investment opportunity. Okay. It may be only one cost of capital or weighted average cost of capital if you have raised money via various methods, debentures, equity, preference shares. So whatever be the case, accordingly WACC is calculated. Next, obviously, there are some advantages, disadvantages of both NPV, IRR. So we'll just see it. Then we'll learn here discounting, how to discount a single sum of money. Suppose if I'll say, I'll give you 1 lakh rupees after 10 years or 2000 rupees right now. So what is beneficial to you? How to see? So only measure to see it is to have a common parameter. We will just discount it back. If that 10 lakh rupees is received today, what is its present value? Then I will compare with 2000 rupees, whether 2000 is more or 10 lakh. Then I'll calculate and decide on it. It could be single sum, only one amount that is received after a particular year, or I can say instead of 10 lakh after 10 years, I'll say I'll give you from 5th year 1 lakh per year till 10 lakh rupees. Means from 5th to 14th year, I'll give you 1 lakh rupees, totaling to 10 lakh, instead of just giving a bullet payment. Then again, you have to discount it back all these payments to year 0 and then compare with the one sum that is being given to you as a compensatory amount of these particular cash flows. Perpetuity. Perpetuity, suppose I'll say you, yeah, right now you take from me 1 lakh rupees, or after 10 years, you take from me 5,000 every year. Till the time you are available on this earth, you take 5,000 perpetual amount. Then again the question comes whether to receive amount right now or whether to receive every year something till perpetual time means forever. What is beneficial? Then again we have to discount it back, the perpetuity, then compare with the bullet payment that is being offered right now and see what is beneficial to me. Then we'll see annuities also. Same, just as single sum annuity means same sum given for a particular amount of year. There won't be any difference in the amount that is being offered to you every year. Then it is called perpetuity. So again, whether perpetuity is beneficial or not, we'll just see by discounting it back to year 0 and comparing with the amount invested. Then what is advance and delayed payment? So general assumption which we take is that we receive cash at the end of the year. So maybe if nothing is given in the question, then you have to take this assumption. If something is given, suppose the payment starts immediately or payment starts at once, then obviously it is not true. Then we have to take advance payment or delayed. Delayed means payment doesn't start from year 1, it starts from year 5. Then obviously we have to discount it back to year 0 by taking the sum till year 5 and then putting the discounting factor. So we'll see how to calculate the advanced or the delayed payments. Okay. So starting one by one with this chapter, whatever is the points we'll cover one by one. First is the time value of money. What is time value of money? It's basically that you are comfortable in receiving something today instead of waiting to receive it after 5 years or 2 years or 3 years, whatever be the time frame. It's a saying, a bird in hand is always a better in the bush. So similarly, if you can receive amount right now, immediately, then always it is better than you receive the amount later on over the period of time. How to justify this statement is the time value of money. Because when you receive something after an year or after 2 years, whatever the period of time, you lose the purchasing ability of that amount. Plus, there is a risk involved in it. And third, you lose the opportunity or the opportunity income that could be earned on that amount if you would have invested that amount somewhere else. Okay. So money received today is worth more than the sum received in the future. That is, it has a time value. This occurs basically because of three reasons. Potential for earning interest. Obviously, if I could invest it somewhere, I'll earn something. Similarly, if I have borrowed it to invest here, I will be losing the cost of finance. Suppose I have borrowed 100 rupees for 10% interest. To invest it somewhere, I have two options. You invest this amount in year 0, or you can invest this amount in year 5. Return will be same. If someone is given this option that you can invest 100 rupees which you are borrowing at 10% interest at year 0 or year 5, in both the cases your return will be same. Then what will be my answer? I will say, okay, I'll go by year 5. Why should I waste interest cost for 4 years if I am earning same amount even after investing the same investment amount in year 5 instead of year 0? So how this decision is taken? Because some cost is associated with it. Okay. Then the impact of inflation. Obviously, on any purchasing power, what is it? Purchasing power means what things or how much or how many things you can buy with the same amount of money. Suppose I am having 10,000 bucks right now in this year. I can buy suppose X amount of things. After 10 years, with 10,000 rupees, I won't be able to buy the same amount of things, that is quantity X. Obviously, the prices would have gone up and I would be able to buy something less only. So that is the depreciation in the purchasing power of the money due to inflation that is causing a reduction in the purchasing power, which is a factor that is being considered while deciding for time value of money. Then third and the most relatable thing that we observe every day in our life is effect of risk. Someone comes to you and says, take 1,000 rupees right now or take 10,000 rupees after 10 years. Immediately will say, give me 1,000 rupees right now. I am not here to see 10 years later what will happen and all. Give me 1,000. I am happy. I don't want your 10,000 rupees. So why you have decided? Because of effect of risk. There is always a risk factor involved whenever number of years after which you will be receiving the amount is more. Okay. So same here. Some other things in brief is discussed. That is, first is potential for earning interest. Why time value of money is being taken? Because there is always a potential for earning interest. If a capital investment is to be justified, it needs to earn at least a minimum amount of profit so that the return compensates the investor for both the amount invested and also for the length of time. So some amount is invested for some amount of time. It should compensate both of the things. Okay, before the profits are made. For example, if a company could invest $80,000 now to earn a revenue of 82,000 in 1 week's time, a profit of 2,000 in 7 days would be a good return. However, if it takes same investment but the return 2,000 takes 4 years of time, then the return would be very low. How you have calculated? Because right now in 7 days, if you can earn 2,000, the present value of 2,000, if we see at day 0, then it would be more than the present value that will be calculated if same amount is received after 4 years. It would be very less and it would be very small as compared to the present value that will calculate if the amount is received in 7 days. Okay. Therefore, the money has a time value. It can be invested to earn interest or profit. So it is better to have $1 now than in 1 year's time. This is because $1 now can be invested for the next year to earn a return, whereas $1 in 1 year's time cannot. You have money right now, you can immediately invest somewhere and earn some interest. But if you will receive that amount after 1 year, then your interest opportunity is lost and you will never regain it. Alternatively, in a financial situation, paying out cash immediately leads to an immediate interest charge, whereas delaying the payment to a future day delays the charge and reduces the interest cost and therefore the overall cost of making the payment. Same example what we have taken right now. If you have to invest somewhere by borrowing something, then obviously if you could delay the initial investment, then you can delay the interest cost burden on you and therefore the overall cost will be lowered and your return will go up. Okay. Then another way of looking at the time value of money is to say that any value of cash at a future date is worth less than the same value now. Impact of inflation. As we have already discussed, in most of the countries and in most years, prices rise as a result of inflation. Therefore, funds received today will buy more than same amount a year later. Today, if I receive something, I can buy more, but the same amount if I'll receive after 5 years, I would be able to buy only less amount of things with the same amount of money. So why not to get the amount immediately instead of delaying the receipt of the sum? Then last is risk. The earlier cash flows are due to be received or paid, the more certain they are. There is less chance that events will prevent payment. Earlier cash flows are therefore considered to be more valuable. If I'll give you two options, right now you take 10,000 or after 5 years you take 1 lakh. Obviously, receiving 10,000 today will be more beneficial to you because it is more certain. Who is seeing what will happen after 10 years? So obviously there is a risk associated with duration, that is 10 years of time. So we have to have some adjustment factor for the risk that is there in the delay in the payment. That has to be adjusted, and then 10,000 comparable amount could be calculated. How it is to be done? It is to be done by using the discounting factor, that is none other than your cost of capital for any investment. Compounding also we have just discussed. A sum invested today will earn interest. Compounding calculates the future or terminal value of the given sum invested today for a number of years. We'll just see this illustration. An investment of $100 is to be made today. What is the value of the investment after 2 years if the interest rate is 10%? So after 1 year, what will happen? 100 with 10% interest. So here it is 100. 10% is the interest. So $10 is the interest. Total amount at the end of the year 1 is $110. Now what is invested? It is reinvested. Okay. So 110, on that you will earn 10% interest. That is 11. Okay. So total amount at the end of the year is 110 plus 11. That is 121. So compounding says that you will earn interest on the interest earned in the first year or the previous year. So this is the compounding impact. If I would have earned interest only on 100, then there is no compounding. Compounding means you will be earning a return on the return that you have earned in the previous years. Okay. To speed up the process, we can use a formula to calculate the future value of a sum invested now. The formula is future value is equal to present value, that is the sum invested 1 plus interest rate, that is R, to the power how many years you are investing, how many years you have invested, or for how many years you will be going to invest. Okay, that is N. This is the future value formula. Similarly, we can, this is future value, this is present value, this is the rate of interest, this is time period. We can calculate what is present value. From this formula only directly we can calculate. Present value is equal to future value 1 plus R, that is rate of interest, to the power minus N. This we will just shift here. So it will become in denominator. Then you can just turn it into minus N. Okay. These two formulas just remember. Although if you'll ask, sir, do we have to calculate there? You have three options. First, you can calculate on the calculator. Second, you can calculate on Excel. Third, there is a discounting table which will be given to you in the examination. You can directly refer it, but yes, it has a limitation because it has coverage up to certain percentage or for certain number of years. If you have to go above that, then you have to use this formula. So don't avoid formula thinking that in any case I will given the discounting table. So why to memorize the formula? Formula is important because sometimes coverage of the table is not enough to cover your questions. Okay. The terminal value is the value in n years time of a sum invested now at an interest rate of R. Okay. If we'll see the first question, you have $5,000 to invest now immediately for 6 years at an interest rate of 5% per year. What will the value of the investment after 6 years? So we'll just calculate it. So R, that is rate of interest, is 5%. 6 years is the time period, or N I would say, and P, that is the present value, is 5,000 rupees. We are asked to calculate the future value. So future value, what is it? Future value is equal to present value 1 plus R to the power N. Okay. So directly either we can calculate the discounting factor, that is 1 plus R to the power N, which is none other than 1 plus 5% interest rate to the power 6, or we can directly calculate the future value factor from the table also. Whatever is best to you, you can calculate. Whatever easy, but you have to remember everything. First is formula, how to calculate by a formula. Second, how to calculate using calculator, and third, Excel. So directly we can multiply this future value factor into the present value and we'll get the amount as $6,700. That is the value of the investment that we'll be getting after 6 years. Okay. Now comes the discounting. As the name suggests, we have to pull something back. So every year we'll be receiving something. To make it comparable or to make it cumulative, we'll discount it back or pull it back to year 0 or year 1, whichever year we want to have the view. In a potential investment project, cash flows will arise at different periods of time. Means at different time, different amount will be received. So at many different points in time, to make useful comparison of the different flows, they must be all converted to a common point in time, usually the present day, that is cash flows are discounted. So year 1, whatever you are receiving, you have to discount it back. Year 2, you have to discount it back for 2 years. Year 3, you have to discount it back for 3 years. Year 4, again you have to discount it back to by 4 years, and you have to get all the cash flows at year 0. Then you can compare it with the outflow that you're doing at year 0, and then you can see whether it is having net surplus or net deficit and what is its impact on the cash flow of the shareholder. So if you have to discount a single sum, the present value of the cash flow now of the money receivable at the sum future date is equal to future value 1 plus R, that is the discounting factor, to the power N. So as we have discussed before, it is future value into 1 plus R to the power minus N. So there is a question, test your understanding, that is, what is the present value of $1,15,000 receivable in 9 years of time if rate of interest is 6%? So we'll just see it. $1,50,000 is the future value. Then rate of interest is 6, time is 9. So we know present value is equal to future value 1 plus R to the power minus N. We'll just calculate first the discounting factor, that is 1 plus 6% interest to the power minus 9, or we can just see here also 6% 9. How to see here? I'll just show you. So like this, the table will be given to you in the exam. Discounting factor table. So first you have to see it is 6% interest and period is 9. You just have to go 6% to the period 9. So the discounting factor comes to 0.592. We can directly put it here, that is 0.592 into If he have to calculate the present value, that is into the future value, will immediately get the present value, that is 68068. The cost of capital. So cost of capital will be addressed via different names, that is cost of capital, discounting rate, required rate of return. So number of alternative terms might be used for cost of capital, but what is the amount you are losing or the minimum amount that you want to earn over a particular sum of money that you are investing in a particular project. Now comes the main thing, that is net present value calculation. To appraise the overall impact of a project using DCF technique involves discounting all relevant cash flows. So as we have discussed in the previous chapter, we are now mature enough to calculate the relevant cash flows. What is actually relevant for the particular investment or not? One is obviously the sunk cost that is not to be taken into account while calculating the cash flow. Non-cash expenditure like depreciation, amortization, these things should not be considered while taking into account the cash flows for a particular project. Third thing, any fixed cost allocation that is already incurred and that is not one-to-one related to the project is to be avoided while calculating the relevant cash flows for the particular investment appraisal. Okay. So if we treat outflows of the project as negative, obviously cash is going, so it is negative. Inflows as positive, the NPV of the project is the sum of present values of all the flows, that is inflow and outflow, as a result of doing the project. The NPV represents the surplus funds after funding the investment earned on the project. So what is the surplus that is left or the deficit that is there after comparing the present value of the cash outflow and the present value of cash inflow? It will just show whether you have earned more or you have invested more than what you have earned over the period of time. Now you will ask me, sir, investment will be right now at year 0 or at many years, and simultaneously the cash flow will also come over the various period. Then how to calculate it? Then I will say you have to just pull them back to year 0 and see the net amount, that is NPV, net present value. So net present value of inflow and outflow. If the NPV is positive, the project is financially viable because it is gaining something over the period of time and it is giving a surplus after the end of the project period. If NPV is 0, the project is at break even, means whatever money you are investing, you will be getting back if you discount all the cash flows at a particular discounting rate, that is your cost of capital. So nothing will be left more than the cost of capital. NPV 0 does not mean that you are not even recovering the cost of capital, but you are recovering exactly the amount of cost of capital. So nothing surplus will be left with you. Okay. Then third is NPV negative. It means the project is not financially viable. Why? Because you are not even earning so much amount that your cost of capital will be compensated. In any case, you are putting something from your pocket because of going into this investment. Hence, I will ask you, see, you have to invest something or put something from your pocket to have a particular investment, you will be at a loss. Obviously, nobody will invest. Hence, this project is not financially viable. Now you'll ask me, sir, if two projects are with me, one is giving NPV 1000, another is giving NPV 10,000, then which project should be considered or evaluated, or we should proceed for which project? I'll say, if you have the capacity to take both the project, then you should take both. But if you have the capacity to take only one project and both projects are mutually exclusive, means either one could be taken, then I would say obviously if the project is having more NPV then compared to other one, that project should be opted for investment. Okay. This part is clear, Niti. Which investment should be taken if we have to compare via NPV, because many times question comes while changing the topic on this particular NPV thing, which project to be taken, whether it's mutually exclusive or not. Obviously, if you can go with both the projects, then both should be taken. The NPV gives the impact of the project on shareholders' wealth. This is very important, this line. So just learn it. What does the NPV actually means? We'll just go through by example. Suppose cash flows at 12% interest or cost of return or cost of capital gives you minus $97 NPV. At 10% it is 0. At 8% it is positive 108. Then what will the way of understanding NPV? If the funds were borrowed at 12%, the investor would be at 97 out of the pocket. Means you have to shed something from your pocket over the period of investment, because you will not be even earning so much amount that your cost of capital will be compensated, and at the end of the day you will be shredding something out of your pocket. That is, the investment earns a yield below the cost of capital. If the funds are borrowed at 10%, the investor would break even. Means when I will just moving my hands towards pocket, I will see no, nothing is to be taken out of pocket, but yes, nothing is to be kept within the pocket, and you will not earn anything. 1,000 will be earning, 1,000 will be the cost of capital. So you will be left out with 0. So if it is important due to some other goal, then only this project should be taken. Otherwise, this project is not having any benefit. So if I'll give you a practical example, then I would say, if you are deciding something core to your business and this particular investment opportunity comes, then I would say then this opportunity should also not be taken. But yes, if it is non-core, this is not your forte, it's just a obligation that you have to do for some ESG, environmental goals, social goals, governance goals, and you have to have this project because of some shareholders' expectation or investors' expectation, then only you should go with even the project that is giving you NPV 0. Otherwise, obviously, what we prefer is the third option. If the funds are borrowed at 8, the investor would be having $108 in pocket. So at the end of the period of the investment, something should go into your pocket, something should add to your wealth. Otherwise, we are not here to do charity. So obviously, the project which will give positive NPV is financially viable and is the project that an investor should enter into. He should never go for a project which is having negative NPV or 0 NPV. Okay. Assumptions used in discounting. So till now, whatever we have discussed of NPV, it is based on some certain assumption. Suppose, without looking to this also, we will not read it. If I'll give you one example, year 1, 2, 3, year 1, 2, 3. Here we have received 10, 10, 10. The investment right now is suppose minus 15. Okay. Now you are asked to calculate NPV. I have told you, please calculate NPV, whether we should go with this investment or not. 10% is the interest rate. Okay. So immediately what you will do, you will just pull it back, again pull it back with 2 years, again pull it back with 3 years. Suppose the present value of these cash flows is coming to 21. So you will just calculate NPV and immediately give me, sir, it is positive 6 NPV. So I think we should go with the investment. I said, okay. But while doing this, knowingly, unknowingly, what assumptions you have used is investment is in year 0, means immediate investment. You are doing immediate investment in year 0. One thing that you have fixed. Year 0 is the investment date. Second, the income. Obviously, it won't be key on 31st March or on 31st December. 10 rupees will be earned. It will be earned over the period of time. Every month, every day, or every quarter, you will be earning something. But while calculating, you have done some assumption that the earning will come at the year end. If it is calendar year, then 31st December. If it is financial year, then it is 31st March. So this is the second assumption, that cash flows, even though occur throughout the year, I'll assume that the cash flow is getting earned at the end of the year. Okay. You understood this and this. Okay. Then at the third, that we have assumed one more thing, that cash flow starts at the end of first year. There could be a scenario that I have never said in the question that 10 rupees will be earned or $10 will be earned at the end. Maybe it would have been earned at the beginning. So this is the third assumption that you have made, that cash flow will be earned at the end of the year or at the beginning. If nothing is given in the question, then you can assume 100% times that the cash flow will be earned at the end of the year. If something specific given in the question, that cash flow starts from the beginning, then you have to take assumption accordingly. So obviously, while calculating NPV, there are three assumptions: that cash flow is earned throughout the year, but we'll assume that it is earned either at the end or beginning. If nothing is given in the question, then you will always assume that the cash flow is earned at the end of the year. Third is that initial investment will be done at year 0. That is, immediately it will just flow in the project. If nothing is given the question, because sometimes in question it is given something is investment immediately, something is invested over the period of time, then accordingly you have to change the assumption. Nothing given, then these three are the assumptions. All cash flows occur at the start or end. Initial investment occurs at year 0. Other cash flows start 1 year after the T1. Okay, 1 year after that, that is T1. So here. Also note, you should never include interest payment as cash flow, because obviously you have already included the interest payment via cost of capital or discounting factor. That is none other than whatever you are paying or whatever you are expecting on the amount that is invested in the project. So you can't say, sir, I am taking interest rate 10%. That is my cost of capital. And also while calculating the cash flow, can I deduct the interest payment? The answer is obviously no, because two times you cannot deduct the same things. Once you are deducting cash flow, then again you are adding the interest rate in the discounting factor. That means it is discounting twice, which is wrong. NPV is an important technique which you will develop further if you choose advanced management. That is not the issue. So assumptions: all cash flows occur at year start or end, what we have discussed, and initial investment occur at once, that is T0. Other cash flows start in 1 year's time, that is T1. So we'll just see the first example. The cash flows for a project have been estimated as below. That is year 0, 25,000 initial investment. Then in year 1, you will be getting 6,000. Year 2, 10,000. Year 3, 8,000. Year 4, 7,000. The cost of capital, that is the discounting factor, is 6%. You have to calculate NPV. So what all is asked here? Convert these cash flows to present values and then calculate NPV, and then assess whether the project should be undertaken or not. So one by one we'll do it. First we'll calculate present values of these cash flow, then sum it up to get the NPV. Then we can easily decide whether to go for this investment or not. Okay. So for ease, I have just copied here the cash flows, that is 25,610.87. Discounting factor. For year 0, the discounting factor is 1 only. Year 2, either you can calculate by using this formula that is given here. I have just 1 divided by 1 plus R, or you can see it directly from the discounting factor table. So for first year, 6% discounting factor, we can directly copy from the table that will be given in the examination. 6%, you just go here. First year is 943, you can copy directly. Second year, 890, you can copy here. 840 is the third year. Fourth year is 792. So you can use it directly also. Whatever is convenient, wherever your hand is set, use it. What is our motto? To get the answer in the minimum required time. So we'll just calculate the present values and then the final answer, that is sum of all these present values. So since it is coming positive, NPV is coming positive, if someone asks you whether you should take this project or not, our answer will be yes, because this project is financially viable and is giving surplus at the end, which is increasing the share wealth. So the answer would be yes. Okay. If you want, you can copy. Otherwise, it is given in the book also. What is the major word that you have to add is financially viable. Why you want? Because it is financially viable as it is giving some surplus result. Okay. Now we'll just go back. Second question, same. I'll just give you 2 minutes time. Try on your own. Otherwise, we'll just cover it again. Okay. So we'll just solve it. So year 3, we'll just see this example. Cash flows. Year 0, we'll just invest 2,40,000. Then year 1, 80,000. Year 2, 1,20,000. Year 3, 70. Year 4, 40,000. Then 20,000. The company's cost of capital is 9%. Then we are asked to calculate the NPV of the project to assess whether it should be undertaken or not. Okay. So the investments are 2,40,000, 80,000, 120, 70,000, 40, and 20 as being given in the question. Now the discounting factor is 9%. So same way, either we can do directly via calculations on Excel, or we can just see from here. That is 9%. First year it is 0.917, 0.842. Then we have 772, 708, and 650. Okay, so directly we can calculate by multiplying it. So by this we can get all the present values. And if we want to see the NPV, we'll just add it up. That is giving total around 30,000 NPV. Okay, so if again the question comes whether we should take up this project or not, then again your answer should be, since the NPV is positive, it is a financially viable project and we should take it up as it is giving some surplus at the end of the period of the investment and it is increasing the shareholders' wealth. Okay, we'll just proceed. Now, what is the advantage?
So the project is financially viable.
Yeah, project is financially viable. Okay, you solved it. Very nice. So if we'll proceed with the advantages and disadvantages of using NPV. So advantages is, theoretically, the NPV method of investment appraisal is superior to all others. Why? Because it considers the time value of money. All our problem, whatever we have discussed till now, whether in payback period or annual rate of return or return on capital employed or return on average capital employed, Mostly all the problems will be addressed here. How come? First, it considers the time value of money. So first our problem was all the methods of assessment till now was not considering the time value of money, which is money received today and money received after some years is not same. That is being addressed here. Now, second is it is an absolute measure of return. So it will give an answer positive, negative, zero, by which you can decide. This is nothing, there is nothing left subjective. If your return is this and average return coming this, then you should do or you should not invest. So nothing subjective left. Directly, the person who is evaluating will get an answer whether to invest or not. Next, it is based on cash flows, not on profit. One of our problem was till now, all the methods what we have evaluated is that it is based on profit. Profit is on the basis of some estimate. Estimates are on the basis of some policies. That is again due to some human interventions, and that could change because it is on the presumption and subjective thing, which depends on person to person, committee to committee. While the cash flow shows actual money that is coming inside the business or that is going outside the business. So cash flows are more dependable than the profits. Fourth, considers the whole life of the project. So entire end-to-end life of the project is considered here. In payback period, what I have seen is it is considering only up to the period payback or the amount is recovered from the project. In annual rate of return or return on capital employed, what we have seen is it is just calculating the return. Nothing is taken of time value of money or nothing is taken how many years or anything. Just return we are seeing. So here whole life of the project along with time value will be taken care. Last should lead to maximization of the shareholders' wealth because if we have positive NPV, that will have a direct positive impact on the shareholders' wealth and it will show that their wealth will increase in cash terms if we invest in this particular project. It is not just a dummy number that is ROCE or payback. It's actual positive thing that will be added to the shareholders' wealth. Now, disadvantages, it is difficult to explain to managers. Obviously, it has some calculation, time value of money adjustment, then present value factor has to be there, present value is to be calculated, there has to be estimate for the rate of return that you want from the particular business because of the cost that you're incurring while raising the funds, that is the weighted average cost of capital or just cost of capital. So it involves bit complex things. You have to have the knowledge of it, understanding of it, then only you can decide any investment proposal on the basis of NPV. So it is little bit difficult to explain to managers. Next, it requires the knowledge of cost of capital. As we have said, cost of capital calculation, then weighted average cost of capital calculation. It all involves some understanding of financial jargons. So until unless you have understanding, you cannot be thorough of the calculation and the investment decision, which could be made on the basis of NPV. Last, it is very complex or relatively complex, I would say, because involving these things, understanding it takes some time for the particular person to adjust, without which he cannot decide on the basis of NPV. So you can just see through it once as a homework, you can go through it. In any case, it is same as what we have discussed right now. So just an alternative, it is given time saving in the examination. Although you will be able to perform almost any NPV calculation using the above information, there are a number of time saving techniques that can help you. One is present value table that we are already covering in any case since beginning. It is given in page number 34. If you want to refer, you can directly refer. It is same what we have covered here. So this is discounting table. This is annuity table. We'll cover one by one. It is same from Kaplan. You can refer page number 34. Okay. Why I am always saying that formula is also important. You will think why formula is required when discounting table is there. because discounting table has limitation. First, the number of years, 20 years only it covers. Second, the rate of interest. If I'll say 50% discounting factor, that might not be in the table because discounting table generally covers till 20. So you have to have a knowledge of both formula and table. So that whatever be the case, whatever be the scenario, you should be able to give the answer. Tables could be used as a tool to increase the speed with which you will give the answer, not as the only way to give the answer. Okay. So just a small illustration is there. What amount should be invested now to receive 10,000 in 4 years if R is 8%? So 10,000 you want to receive, that is future value in 4 years. R is 8% per year. Okay. So immediately what you can say, present value. By this formula only we'll calculate future value 1 plus R to the power minus N. Okay. So future value we have it. Or we'll just do it in Excel. Okay. So future value we have it this. Okay. Present value formula we know it. And as given in the question, 4 years 8%. So immediately you can get the discounting factor. 4 years, that is after 4 years you will get with 8% interest rate. So what you will calculate immediately, discounting factor 8%, 4 years, that is 735. So you got directly the discounting factor 0.735 into 10,000 rupees or dollar that you will be receiving after 4 years. So the answer is 7350. That is just multiplying 10,000 with the discounting factor. Now, this was the single bullet payment that you received after 4 years. And for that, I asked you what is the present value. Now, maybe the scenario is you will be receiving same amount. Instead of one bullet payment, you have received 1,000 every year. And I am telling you what should be the present value. 1 you have received. Annuity means same amount. If the amount is not same, then it is not annuity. So I'm telling you, every year you will be receiving $1,000. What is the present value? Then instead of discounting factor, you may go for annuity factor. That will also be given in the table. But parallelly, we'll see what is the formula for calculation of annuity factor also. Suppose a payment of 1,000 is to be made every year for 3 years. The first payment occurring in 1 year's time in T1. The rate of interest is 10. What is the present value of the annuity? How it is annuity? Because 1,000 is only made every year for 3 years. Okay. Interest rate we are having 10% and first cash flow is occurring at year 1. That is end of year 1. We have to calculate the present value of it. So the present value of the annuity could be found by adding the present values of each payment separately. That is T1, T2, T3 payment, discounting factors, present value factor you can see directly from the table. We'll just see it. Okay, 10% year 1, 909, 826, 751 and present value 2486. Discounting factor total is 2.486. Okay. So what is annuity factor? It is just a sum of every year's discounting factor. Instead of every year multiplying and getting total, we will just take the discounting factor sum and directly multiply it. How to see in the table? 10%, okay, 4 years or 3 years. So it is 2.487. So directly 2.486 or 7, just pointer difference might be there into $1,000 you will get. What is exactly happening? So every time, instead of multiplying 1000 into discounting factor and totaling, we'll just sum it up. But when will it work? When the amount received every year is same. If the amount received is same, then only you can multiply annuity factor. Otherwise, suppose here it is instead of 1000, it is 2000. Will your annuity factor work? Because you'll sum it up into this, you will do 1000. Then your answer will not come because 1 year the cash flow is 2000. So ultimately you have to go via table if your cash flows are not same. But yes, if your cash flows are same, then you can go with the annuity factor. Clear? Now this was via table. How can we calculate the annuity factor and how can we calculate the present value of the annuities received? Similarly, there is a formula for it. The annuity factor is the name given to the sum of individual discounting factor. If we sum it up, individual discounting factor, we'll get the annuity factor. The present value of an annuity can therefore be quickly found using the formula present value is equal to annual cash flow into annuity factor. So the same what we have done up, that is annual cash flow into the annuity factor. We got our answer. Okay. Or there is a formula for calculating the annuity factor, that is annuity factor is equal to 1 minus 1 plus rate of interest to the power minus n, that is time period, divided by r, that is interest rate. So if you want to calculate the annuity factor, then the formula is 1 minus 1 plus r to the power minus the time period divided by r. So we'll just see to it whether the answer is coming same or something different via this example. A payment of $3,600 is to be made every year for 7 years. So 7 years is equal to the time period. Okay. And the annuity payment is 3,600. Okay. The first payment occurring at 1 year's time. So first payment आपका कब हो रहा है? T1 पे. Okay. And the interest rate is 8%. So first we'll calculate the annuity factor. Then we'll just calculate the present value. Present value is in any ways equal to annual cash flow into annuity factor. So if you want immediate answer, then you can just refer the table. I'll just solve this via both the things. So 7 years is the time period, 8% is the interest. So annuity table, 8% is the interest, 7 years is the time period, that is 5.206. Okay. 7 years, just a cross check, 8%. So 5.206. 5.206. Okay, and 3,600. We will get the immediate answer. Or else, if we go via formula, which is we have to cover here so as to have an understanding. N is equal to 7 years, amount is 3,600, R is equal to 8%. Okay. Formula is annuity factor is equal to 1 minus 1 plus r to the power minus n whole divided by r. So 1 by 1 will calculate 1 plus r to the power minus n, that is 1.08 to the power minus n minus 7. Okay. Then we have to calculate 1 minus 1 plus r to the power minus n. So 1 minus I have done the amount calculated above. And in totality, the formula, that is 1 minus 1 plus r to the power minus n whole divided by r. So we'll get the annuity factor. So what is the annuity factor? 5.206. So it is coming same, what we have directly seen via annuity table. Then if you will think then why to go via formula, you should know the formula. If it is available in the table, then you can go directly. But if it is not available, then you should be able to go via the formula. That is our sole motto. Then we can directly calculate annuity amount into annuity factor. That is this annuity factor into annuity amount. And we'll directly get the answer. So same way here it is written that we can see via annuity table or formula. There might be small difference due to roundings, but yes, we should be able to calculate via both. So this question you try, a payment of 1,11,400 is to be made every year. Sorry, a payment of $11,400 is to be made every year for 13 years. The first payment occurring in 1 year's time, the interest is 5%. What is the PV of the annuity? Show via both formula approach and table. Just try it once, Niti. Take 2 minutes and try it. So here if I'll sum up, it is 13. Okay, just making it a bit easy. 5%. And the amount is 11,400. Just try it once. We'll just solve it after 2 minutes.
Sir, the answer is 1,07,091.6.
Okay, we'll just solve it. Very good. It's correct. Very nice. So you have used this formula directly annuity table. Niti, you have used formula directly annuity table.
Sir, I used annuity
Table. Okay, just try this formula also. No? Are you getting the same thing?
Okay, sir.
Yeah, just try it.
I'll try this.
Yeah. Okay. Niti, maybe we'll continue. You can see here and you can try accordingly. So again, 1 plus r to the power minus n, that is 1 plus rate of interest to the power minus 13, that is n. If we have to 1 minus 1 plus r to the power minus n, we'll just subtract it from 1. And then at the end, the final formula, that is divided by r also, will get annuity factor 9.394. So if we want to calculate the present value, that is the annuity factor 9.394 into annual cash flow that we'll be getting is $11,400. So total it is coming 107,087 as you have calculated. Okay, very good. Our perpetuity is an annual cash flow that occurs forever. Perpetuity means you will be receiving for entire period. There is no stop. There is no long stop date. You will be receiving for perpetuity till lifelong. Okay, that is perpetuity. Don't be confused of what is perpetuity. Is there any end to it or anything? Just you can memorize by it will be receiving for entire period. There is no end. Okay. It is often described by examiners as a cash flow continuing for the foreseeable future. Foreseeable future, they might say, if I foresee any future, it is there. So means basically you will receive for your entire life period or life period of the business. Okay. So if a question asks what is the present value of the perpetuity, then the most easy formula is cash flow divided by the rate of interest. Directly you can do this and get the answer. So present value is equal to cash flow into 1 divided by R. 1 by R is the perpetuity factor, that is discounting factor or annuity factor for the perpetuity cash flow. A cash flow which we will be getting for perpetuity means there is no end to that cash flow. A PV of a growing perpetuity is found. Suppose if I say you will be receiving 1,000 every year with a growth of 2%. So first year you will receive 1,000. Next year you will receive 1,020. Then again, like this, it will go on increasing. But yes, there is no stop to this payment. Then you will see, sir, then how can we calculate? Can I directly calculate? Suppose the discounting factor is 10%. Can I directly calculate 1,000 divided by 10 here also? I would say no, because there is the growth factor also involved in this. Then, sir, there is no end. How to discount it back? What should be the present value? Then there is a formula for it. That is T1, the cash flow that you will receive in T1 into 1 plus 1 divided by R, that is discounting factor, minus the growth rate. So, suppose here if we say, then the answer would be 1,000 divided by 10% minus 2%. So our answer would be 10,000 divided by 8%. So how come growth factor is being embedded in this? By reducing the discounting factor. 10,000 divided by 10% would give only 10,000, but divided by lower the interest rate by which your amount is being divided, the higher would be the present value. So similarly here what we have taken 1,000 divided by 8%, that is after reducing the growth factor. Okay. Just try this once. I'll just share again. Okay, so we'll just solve it. If maybe we can solve together. I'm sure. So first is calculate the present value of the following, assuming a discount factor of 10%. $3,000 received in 1 year's time, that is T1 forever. So which is simple, 3,000 divided by 10%. Immediately we'll get the answer. Okay. $3,000 received in 1 year's time, that is T1, then growing by 2% every year till perpetuity. So simple. Again 3,000 divided by discounting factor, that is 10%, minus the growth factor, that is 2%. So 3,000 divided by 8%. Okay, just see here. So the amount is 3,000. 10% is the discounting factor. Okay. And year is in any case perpetuity. If we have to take growth, then it is 2. So first case cash flow, that is 3,000 divided by 10%. Directly we'll get the present value 30,000. If we have to take the growth factor also into account, then the T1, that is 3,000 divided by 10% minus 2%, that is our rate of interest minus the growth factor. Immediately we'll get the amount as 37,500. So obviously if there is a growth factor involved, the amount is more. And if it is no growth that we are envisaging in the amount, then the amount is directly coming to 30,000. That is just cash flow divided by the discounting factor. Okay. Now going to advanced and delayed annuities and perpetuities. So how to calculate advance? Advance means the annuity begins immediately. Right now what we are assuming is the annuity we will be getting after year 1, that is at T1. Now the question will modify accordingly. Once you will get more mature in this chapter, you will get to know different types of question. Suppose if I am receiving immediately the amount and then going forward, suppose I am receiving from T5, means year 5 we are getting the amount, then how to calculate the present value. Suppose till year 5 the amount we were receiving were suppose different cash flow, but from year 6 I am seeing that I will be receiving perpetual amount, then how to calculate cash flow. So slowly there would be more complexity in the question, but yes, since we are building block one by one, we'll never face any difficulty in resolving it. Okay. The use of annuity factors and perpetuity factors both assume that the first cash flow will be occurring in 1 year's time, that is at the end of year 1. Annuity and perpetuity factors will therefore discount the cash flows back to give the value 1 year before the first cash flow arose. Okay. So what is happening from here if cash flow is coming? Okay. So annuity factor, when I will put and get the value, then here is the present value what I am getting. Okay. So at 1 year back from where the cash flow starts. If we'll say that, sir, the cash flow will start from 5th year, and if I'll use the annuity factor, then 4th year end or 5th year beginning is the annuity cash flow that I will get. If I'll put the annuity factor, then immediately I will get the cash flow, total cash flow, or the present value of the cash flow at the beginning of the year 5. Okay, so 1 year back it pulls. But if you'll ask me, sir, I want cash flow at year 0, then I have to discount it back for 4 years to get the cash flow for year 0. I'll just show you with an example. Don't worry. This is bit confusing, but we'll just see it. Don't worry. Some regular cash flows may start now, T0, rather than in 1 year's time. Calculate the PV by ignoring the payment at T0 when considering the number of years. So suppose if I'll say a 5-year $600 annuity is starting today. From year 0, you will get the interest rate are 10%. Find the PV. So year 0, you will receive this. Then in any case, annuity, you know that you have to have cash flow from year 1. Then only you can put the annuity factor. So if I am saying that you will receive 5 cash flow, year 0, 1, 2, 3, 4. Then immediately you take the annuity factor for 4 years, then add this year 0 cash flow, because in any case we have seen that the present value of the amount that is received in year 0 is always 1. Means the present value factor is always 1. So the amount will remain same. So directly we can calculate the present value of 4 cash flow, add it the cash flow that will receive in year 0, and then we can get the entire present value. We'll just show you by example. Okay, so 5 years 600 annuity is starting today. Interest rate is 10%. So this is essentially a standard 4-year annuity with an additional payment at T0, that is 600. First year immediate payment that you will getting, you can add directly in the at the end to the value that you will getting by annuity factor calculation. So T1, T2, T3, T4, 4 years annuity you can take. Okay, you can take 4 years annuity factor, 10% 4 year, 10% 4 year, that is 3.170, 3.17 into 600 plus the beginning T0 600 cash flow. So total is coming to 2502. Okay, it could be calculated similarly in one more way. 3.17 is your annuity factor for 4 years. In any case, we know that the discounting factor for year 0 is always 1. So total annuity factor comes to 4.17. You can directly multiply this into 600. So you will get the answer 2502. Okay, is this clear, Niti?
Yes, sir.
It is a bit confusing topic. So now 100% clear that T0 you have to take discounting factor 1, T1 to T4 annuity factor if you have to calculate, you can see via table and then add 1 to get the cash flow which is starting, or annuity which is starting from year 0. Okay. Okay, we'll see one more example. A perpetuity of 2000. Perpetuity means this cash flow you will be receiving for foreseeable future, or there is no end to this cash flow. Every year you will be receiving, is due to commence immediately. That is from year 0 it will start. The interest rate is 9%. What is the PV? That is present value. So we knew few things, that when we want to calculate the present value of the perpetuity, we can directly put one formula, that is annual cash flow divided by annual cash flow. We can have divided by the R, that is the rate of factor, discounting factor. But that is applicable for the cash flow that will receive in T1. There is one cash flow which will receive in T0 also. So there are again two ways to calculate it. I'll just show you. So T0, you will receive 2000. Okay. From T1 again, you will be receiving 2000. There is no growth factor involved in it. So if you want to calculate the present value of this, you can directly put 2000 divided by the rate of interest, that is 9%. Okay. Whatever be the amount, you can just add 2000 to it and you will get the total present value of this 2000 being received immediately till perpetuity. Okay. So that is present value 2000 year 0 amount received plus whatever perpetuity you will be getting from year 1. So in totality it will come 24,222. One more way to do it is present value factor. If you want to calculate, or annuity factor, you can directly do one thing. In any case, the present value factor for year 0 is 1. You know the present value factor for other years, that is 1 divided by 0.09, that is the rate of interest. So directly total you can get, that is coming to 12.11, and you can multiply it with the annual cash flow, that is 2000, and you will get the answer as 24,222. Okay, so find the present value of the following cash flows. First is 15-year annuity of $300 starting at once. Interest rate are 6%. Okay, first is 15 years annuity. I just copied here 15. Interest rate is 6%. So 6%. 300 is the annual cash flow. Annual cash flow is $300. And starting at once means you will be receiving amount from year 0 only. Okay. Then we have to calculate first the annuity factor for n minus 1, that is 15 minus 1. Why 15 minus 1 I have taken? Because here you are receiving 15 annuity, but you are starting from year 0. So in any case, for annuity factor calculation, we'll take for 14 years. Then on that annuity factor, we'll just add 1 because that is the present value factor for year 0, and we'll get the total present value or annuity factor for the entire perpetuity amount that we'll be receiving. Okay. So if we see the annuity factor for n minus 1 years, that is 14 years at 6% interest, we'll just see 6% is the interest, and if we see 14 years, that is 9.295. 6% interest and 14 years 9.295. Okay, so 9.295 is the annuity factor for 14 years. The present value factor for year 1 or year 0, sorry, I would say year 0 is always 1, so we'll just add 1 to it. We'll get the total annuity factor, that is 10.295. If we want to calculate the present value, we'll just multiply this annuity factor with the annual amount that I'm receiving, $300, totaling to 3089. Is it clear, or any doubt here?
No, sir.
Okay. So second, a 7-year annuity. So N is 7 of $450 starting immediately. That is from year 0. Interest rates are 11%. So we'll just copy here. 11% is the interest rate, 7-year annuity, and the amount is 450. Again, we'll just calculate annuity factor for 6 years because it is starting immediately, and year 0 present value factor is 1. So we'll calculate for 6 years, then add 1 to it, we'll get the total annuity factor. So 11% for 6 years, we'll just see. So 11% for 6 years, 4.231. Okay. 11%, 6 years, 4.231. 4.231. We'll just add 1 for year 0. That is the annuity that we'll be receiving immediately. And then for present value, we'll just multiply the annuity 450 into the annuity factor 5.231. And we'll get the answer 2354. Okay. Next. A perpetuity. Now, a perpetuity means it will be received in per infinity. There is no stoppage to this amount of $33,000 commencing immediately. So from year 0 only it will commence. Interest rates are 22%. Okay. So example 3 will see what is it? 22% is the interest rate. Okay. Amount perpetually what you will receive is $33,000. So again, if we'll see the perpetuity annuity factor for n minus 1 year, it would be 1 divided by the, for perpetuity in any case, the annuity factor is 1 divided by the R or interest rate, that is 22. So we'll get this. We'll then add 1 for the year 0. Present value factor for year 0 is 1. So we'll just add it. And then to get the present value, we'll just multiply the annuity factor into the annual cash flow, that is 33,000. So in totality, we'll get the amount as $1,83,000. We'll go to next question. A perpetuity of $14,000 starting at once means from year 0. Interest rates are 12.5%. Okay. So this could be done immediately. What we have just now we have done. It is perpetual, 12.5% is the interest, $14,000 is the annual cash flow. If we want to calculate the annuity factor for n minus 1 year, that is after excluding year 0, it is 1 divided by 12.5. So we got 8 plus 1, that is for year 0, the present value factor for year 0. And then to get the amount is annuity factor into the amount. Okay. All the points here are clear, or anywhere you want again explanation, we'll just do it. For this question, all parts are clear?
Yes, sir. Everything is clear.
Okay. So now we'll see the delayed annuity. Means it may not start from year 1. It might start from year 5, year 6, year 8. Then how to get the present value factor? So some regular cash flows may start later than T1. These are dealt by applying the appropriate factor to such cash flow as normal, then discounting your answer back to year 0. So what will happen if I'll show you? Okay. So I am telling that the annuity will start from year 4. Okay. From here, our annuity will start. I'm not saying that immediately the annuity will start, but I'm telling from year 4, you will receive 500 rupees or dollar annuity every year. Now, you will say, sir, I knew that if it will start from year 1, that is at the end of year 1, then I put annuity factor and I immediately get the present value at year 0. When I'm standing here, I'll get the annuity present value. Now you are telling that we are starting from year 4. Then how will I calculate? It's very easy. Just like here you calculated that year 1 end, the cash flow will start. You will just multiply with the annuity factor and you will get the present value at year 0. That is year 1 end beginning. Okay. Same way, if the cash flow starts from year 4, and you can put the annuity factor here. Okay. you will get the cash flow at the year 4 beginning. The present value at year 4 beginning after putting the annuity factor. Now you want at year 0. So 3 years discounting, 4 years discounting you can do and get the value at year 0 directly. So we'll just get it more clear by example. So just a brief or just a lining you can create. Then later on, we'll just go through all the examples. For delayed cash flows, applying the standard annuity factor will find the value of the cash flows 1 year before they began. So here, 4th year end, so it will give the cash flow at 4th year beginning. Then 4 years discounting you will do to get the value at year 0 or at the beginning where you are standing right now. Which in this illustration is T2. To find PV and additional calculations required, the value must be discounted back to T0. Okay. So if I'll see this example, what is the PV of $200 incurred each year for 4 years, starting in 3 years time? Okay. If the discount rate is 5%. So after 3 years, it will start. It will continue for 4 years. Okay. You want the value, present value at T0. So when you will put the annuity factor here, immediately you will get the value at 3rd year beginning or 2nd year end. So now if you want to have the value at T0, then 2 years discounting factor you can put and get the present value at T0. Is it clear, this particular illustration, Nite? Or shall I once again cover
Yes, sir.
it? Clear, na? 100%?
Yes, sir. Do it once again.
Okay, I'll do it once again. Okay. So what is the present value of 200 that will be received each year for 4 years, starting in 3rd year time? So it will start from year 3. Okay. For 4 years, it will be incurred. When you will be putting the annuity factor, you will get the value at 3rd year beginning. Okay. Just like when you were putting annuity factor for the cash flow that we were receiving from year 1 end, you were putting annuity factor directly, we were getting the value at T0 because that was the present value. Similarly, if we'll put the annuity factor at the year end of 3rd, then you will get the present value at the beginning of year 3 or at the end of year 2. Okay. Now, since you want the cash flow at year 0, so 2 years discounting you will do and get the present value at year 0. Okay. So first step is 200, 4 year 5% annuity factor will put. This amount you got at year 3 beginning. Year 3 beginning. Okay. Now you want at year 0. So 2 times you have to discount. One time you will get year 2 beginning. Second time you will get year 1 beginning. That is year 0. So 2 discounting factor you have to put, that is 709.2 into 2 year 5% discounting factor you will put 0.907. You will get the answer 643. $643 received today is equivalent to the amount that we'll be paying after 3 years. For next 4 years, 200 rupees if we'll pay. Now this illustration is clear?
Yes, sir. It's clear now.
Okay. Now first question we'll just do. A 15-year annuity of $300 starting at T3, that is 3rd year. Interest rate is 6%. Okay, we'll just do. So 15-year annuity is there. 15 year is the annuity period. It will start from T3, 3rd year. Okay. Interest rate is 6%. We want the present value of it. Okay. T3. If we'll put the annuity factor, we'll receive the present value at T3 beginning or T2 end. Okay. So 300 is the annuity amount. We'll just see the annuity factor for 15 years with 6%. 6%, 15 years, 9.712. Okay. 9.712, 6%, 15 years. 9.712, we'll just multiply it. Okay. We'll get the amount. Now it is at T3 beginning. Okay. We are at T3 beginning. We want to go at T1 beginning. Okay. So 2 years discounting has to be done. Okay. So again, the interest rate is 6%. Now we have to calculate 2 years discounting factor. So discounting factor will go 6%, 2 years. That is 890. 6%, 2 years, 890. 890, we'll just multiply this, the present value that we got via annuity factor at T3 beginning into 2 years discounting factor, that is 0.890, we'll get 2593. Is this calculation clear, Nitin?
Yes, sir.
Okay. Now second is a 7-year annuity of 450 starting in 5 years time, interest is 11%. So 7 years is the annuity starting in 5 years time, that is from end of T5. 11% is the interest and the amount, annuity amount is 450. So 11%, 7 years, we'll just see the annuity factor. 7 years, 11%, 11%, 7 years. 11%, 7 years, 4.712. So 4.712 is the annuity factor. We'll just multiply it. We got this at we got this as T5 beginning, okay? Because this annuity was starting from end of T5. So we got this amount, that is annuity amount at T5 beginning. Now we want at year 0. That is 4 times we have to discount back to get the amount at year 0, okay? So again, the interest is 11%, discounting factor for 4 years. So 11% is the rate, discounting factor for 4 years. 1, 2, 3, 4, 0.659. 11%, 4 years, 0.659. So we'll just put here and then we'll get the amount present value at year 0. That is the present value at T5 beginning into the present value factor for 4 years at 11% interest. Okay. Now comes the 3 example of perpetuity. A perpetuity of $33,000 commencing at T2, interest rate 22%. So we'll be receiving that perpetuity from T2 after end of year 2. So it is a perpetuity question. Rate is 22%, amount $33,000. So if we'll put the annuity factor, that is 1 divided by R. For perpetuity, we have the factor, annuity factor is 1 divided by R. It will give me the value at T2 beginning. Now we want to have it at year 0. So we'll just discount it back 1 year to get the value at year 0. So 1 divided by the rate, that is 22%. So amount will get 33,000 into the present value factor, annuity factor, that is 4.545, will get 1,50,000. And this is at T2 beginning, okay? We want at year 0, correct? So we'll just 1 year, we have to put discounting factor, that is 22% for 1 year. So 1 divided by 22 per 1.22, we'll get 1.820. We'll just multiply it and get the amount at year 0, that is 122,951. Okay. So what the question says, find the present value of the following cash flows. So whatever cash flow is occurring at different period of time, this is basically a standard case when your cash flow is not starting from the beginning. Like from year 1 only it is not starting, but it is starting somewhere else. If our time chart is like this, so what is happening? What is the concept? I'll just tell you. If it is 0, 1, 2, 3, 4. Okay. So if I ask you, if I'm standing here only and I ask Niti, just calculate for me the present value of the annuity. What you will do? Simply the cash flow, annual cash flow you will take, whatever will be the annual cash flow, and divided by directly you will do the discounting factor, that is R. Correct? Till here I am correct, Niti?
Yes, sir.
Okay. Now I am just little bit changing the scenario. Now the scenario is like this. Suppose I am standing at year 2, or if I take exactly the question, just take the question only. I am standing a perpetuity of $33,000 commencing at T2. Okay. So T2, it will start 22,000 you will be receiving every year as a perpetuity, means it will be for all the years which you can see, and it will not end. But the difference only is right now we are not standing here. Instead of that, we are standing at T2. Okay. So it will start from T2 every year you will receive. So immediately, if I say, Niti, just calculate for me the present value of all the cash flows. You will just do one thing. You will divide $33,000 by 22%. But now, what is the difference in the scenario? You will get the present value at the beginning of year, 1 year back. From year 2, it will be starting. Year 2, every T2, you will be receiving every time. So, you will be getting the present value. That is the cumulative bucket that you will be getting over the years, where you will get at the beginning of year 2 or at the end of year 1. Because here also when you are doing, if I say it will start from year 1, then you were getting the present value by this formula at year 0 or year 1 beginning. Similarly, if I say you will be using this formula at year 2, then you will getting the present value at year 1 end or year 2 beginning. So now if I say you have got here the present value by dividing $33,000 by rate. Now in any case I am standing here. So I said you give me right now what is the present value. So we will just discount once more by 22% for 1 year, and you will get the cash flow at year 0. Okay. Clear? This is clear, Niti?
Yes, sir.
So same way in the formula, if I say it is a perpetual payment which is starting from T2 and interest rate is 22%, the amount is $33,000. Okay. If I calculate the annuity factor, then it is just 1 divided by 22%, that is your rate, and my amount at the beginning of T2 or end of T1. अगर एक सिंपल वे में अगर मैं बोलूं, जहां से कैश फ्लो शुरू हो रहा है, फ्रॉम वेयर एवर इट इज स्टार्टिंग, उसके बिगनिंग में चला जाता है जब भी आप प्रेजेंट वैल्यू एन्युटी फैक्टर कहीं पे भी लगाते हो. तो अगर हम ईयर 10 बोले, ईयर 10 पे आपने लगाया फॉर्मूला, तो ईयर 10 के बिगनिंग में चला गया. अगर ईयर 0 पे लाना है तो उसको 9 बार डिस्काउंट करके आप ईयर 0 तक लाओगे. बस इसमें यही हमेशा माइंड में रखो, नथिंग टू क्रैम कि यहाँ 2 का 1 हो रहा है, 1 का 2. सिमिलरली 10 पे है तो हम जब डिस्काउंट करेंगे तो 10 के बिगनिंग में चला गया. अब हमें ईयर 0 पे लाना है तो 10 माइनस 1 से हमें डिस्काउंट कर देना है. इसमें कभी भी कंफ्यूज मत हो. मैंने इसीलिए टेबल भी ऐसे ही बनाई है. डायरेक्टली आप देखोगे कि यहाँ पे 2 है, यहाँ पे 2 है तो 1 है, 5 है तो 4 है, 3 है तो 2 है, 10 है तो 9 है. इसमें कभी कंफ्यूज मत हो. जहां पे हम डिस्काउंटिंग लाएंगे उसके एक पीछे चले जाएंगे. तो T2 पे लगाए तो T1 पे चले गए, फिर हमें 0 पे आना है तो एक बार डिस्काउंट और कर देंगे. ऐसे हमेशा अपने माइंड में विजुअलाइज करो जब भी क्वेश्चन आए. कभी भी घबराओ मत कि अरे T3 से हम कैसे लाएंगे T0 पे. डिस्काउंट लगाने पे एक पीछे खुद से आ जाता है. या
Sir, sorry, but I don't understand English.
Okay. So similarly, what I will tell you, when you will apply the discounting factor, immediately one back is pulled. Suppose T3, I'll apply the discounting factor, it will be pulled back to T2. Now if I want at year 0, then 2 more discounting factors have to be applied. So never fear how to get at year 0 when I am getting cash flows from T3 or T10. So immediately whenever here what I have done is, if it is T2 and you are applying the present value factor, annuity factor, then immediately one pullback is automatic and then one more is required to get at year 0. Okay. So if I'll calculate the present value by using this annuity factor, that is 1 divided by 22%, I got this at T2 beginning, year 2 beginning. Now if I want to again pull it back to year 0, then one discounting factor I have to put. So that is for 1 year. So 1 divided by 22%. If I'll multiply this discounting factor with the amount, it is going to come this value at year 0. Is it clear, Niti?
Yes, sir, it's clear.
Okay. Okay, next question if we'll take. I thought little bit English in the mix. Okay, but I'll just ensure that everything is now in English. Okay, so don't worry. A perpetuity of $14,000 starting in 10 years time. So right now we are standing at year 0. Perpetuity will start from year 10. Okay. So you tell me, if I'll apply here the present value factor, the present value which I will get by using this annuity factor will be at year 10 beginning or year 9 end, or where will I get the present value by using the annuity factor? This annuity. Just try once. So if I am using the present value factor at year 10, I will get the present value of the future cash flows of annuity or perpetuity at what? Year 10 beginning, correct? Is it clear?
Yes, sir. Year 10 beginning.
Okay. So if I want to have it at year 0, then I have to discount it for how many years?
1 years.
No, I am at year 10 beginning. Now I have to go to year 0. So how many discounting years are there? 9?
9 years.
9. Okay. Okay. So we'll just solve accordingly. It is a perpetual cash flow. It is starting from year 10. Okay. It is 12.5% interest or discounting factor, for which we will be calculating annuity. Then amount is 14,000. Okay. Then annuity factor, if I calculate, is 1 divided by R. That is coming 8. Okay. If I'll just get this amount, 14,000 into the annuity factor, $1,12,000. This, as you have correctly mentioned, I have got at T10 beginning. You have only identified, very good. Now how many discounting we have to do? It is 10 beginning to year 0. That is 9 years we have to jump. I'll just show you to remove your confusion how it is getting here. This is very important. 1, 2. Okay. So some cash flow, it is starting from here. When I have applied the discounting factor, that is 8, the cash flow that I have got is at year 10 beginning. Okay. 10 beginning. Or year 9 end. Year 9 end or year 10 beginning. That is 31st December of year 9 or 1st January of year 10. We consider it as a same day. So there is no difference between these 2 days. 1 day difference we will not consider in our calculation. So now how many years we are discounting to get at year 0 is 9 years. Like this we are taking. So 9 jump we have to do to come to year 0. Okay, clear?
Yes, sir.
So now 9 discounting we have to do to come at our year 0 amount. So what we'll do, we'll just see the discounting factor of 12.5 with 9. Now I will tell you why I always emphasize to also know the formula. Right now there is no table for discounting of 12.5. See, we have table for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. How will you calculate a discounting factor for 12.5? It is only possible when you know the formula. That's why formulas are very important for you. Otherwise, you will get paralyzed there. You will not know how to calculate. So here, since we know that is 1 plus r to the power minus n. So 1 plus 12.5, that is our discounting rate, to the power minus 9, that is our years. We got 0.346. If we multiply this $1,12,000 into 0.346, our present value at year 0 comes to 38,801. Okay, clear?
Yes, sir, clear.
Okay, last one you will try for me now. I'll wait for you. Okay, you will give me answer. A perpetuity of 2000 starting in year 6 time. So it will start in 6th year time, growing at 3% per year. Interest rate are 10. Will you be able to calculate?
Sir, I'll try.
Yeah, try now once. Otherwise, we'll do together. No issues. One hint I am giving you here, you can use it.
Sir, 17,742.
Correct. Very good. Very, very, very good. Super. So it is again perpetual. It is starting from T6, that is year 6. And the discounting rate is 10%. Growth is 3%. So annual cash flow is 2000. So we'll just calculate this. That is one annuity factor. That is 1 divided by R minus G. We got 14.286. We'll just multiply it. We'll get the present value at year 6 beginning. Okay. Then we'll just discount it back to year 0. Because we are standing at year 6, we want to go to year 0. So the discounting is of 5 years. We'll just see 10%. What is the discounting for 5 years? Directly we can get the discounting factor from here. That is 10, 5.621. Okay. So we'll just multiply it and get the answer 17,742. Very nice. Good. Okay. So what is next is computer based exam, time saving techniques. Obviously you will be given Excel also. So some formulas. In any case, what we are doing in Excel, I always show you formula also. If you need any help in formula, if you have not tracked it when I am working on the spreadsheet, you can just ask right now anytime. So also put attention while using the formulas in the Excel. So it is just written in the constructed response spreadsheet workplace. Use can be made of spreadsheet functions to speed up the calculation. Some Power SQRT are available within the spreadsheet workspace. Make sure you're comfortable with it. In any case, what I am using here, formulas and all, hope you all are tracking it. And if any discomfort you are having, you can just stop me wherever you want.